The second theme that we've covered in the past, just to reiterate this, since COVID, from 2019 onwards, one of the spaces that has gotten hit significantly in India is the average household income of the lower middle class not growing. And that, even if it grew at less than GDP, the package of where they spent changed significantly. So rather than spending in pure play FMCG, there was a lot of spending on what you call as mobile and data, etc. As a result of which the spending patterns changed. Hence, rural recovery that was expected took way longer than expected. Now, this last 2 to 3 quarters were the first signs that rural recovery is actually happening. Some part of it is internal and some part of it is because of the government push. So post-elections, we spoke about the fact that state elections coming through will drive spending from the government. We're seeing the first signs of rural recovery growth coming through, and that's a space I think gives both a defensive positioning as well as an increased rate of change of growth. So here again, this part of the portfolio is not going to generate nonlinear returns, but what it would do is it would protect you against drawdowns because of the fact that you've not seen growth for 5 years. Incrementally, you're seeing growth. This part of the portfolio will also lend itself into a higher ROCE because margins are also expanding. The third theme that we like, that we believe is an interesting theme over the next 3 years is metals. Here again, if you just look at the 4 charts, which I'll just walk you through, pretty much everyone is aware that non-growth fiscal spending in the US is at an all-time high. What that means is what US needs to be spending in order to service its interest debt, right? Now, you've seen Fed cut rates by 50 basis points. Maybe they will do 1 or 2 more cuts going into the elections. But I still think because of the way the world has to spend, both from a manufacturing and a power perspective, inflation is here to stay. So structurally, I think we are going into a higher inflation economy rather than a higher deflation economy, which means I don't think there has to be a floor on interest rates. And with the way the government balance sheet has expanded in the US, this fiscal spending, I think there is a floor to it. Now, what you've also seen, which is shown on the chart on the right, is the global money supply. So this talks about not just the US, but the actual money supply that is coming in, including countries like Japan, China, etc. And that is again on an uptick. Maybe US is not expanding its balance sheet, but today China is taking over. And when money supply increases, that is again an inflation in terms of assets. So this third chart just explains to you when M2 money supply goes up, generally it is inflationary in nature because that is a proxy for CPI as well. All of this effectively means one of the sectors that globally we have underinvested in is metals, because between when I spoke to you about a deflationary economy between 2010 and 2021, one sector alongside power that got affected was metals, right from gold or copper. The new mining capacity never expanded. As a result of which, when you look at the price of metals over that decade, it just went down. Today, what you are seeing is an inflation in some of these prices of these metals between, let's say, 21 to 24. But even at these higher prices, capex has still not come through. And if the world has to go into a manufacturing economy, and so specifically with India, a lot of these mines have to be restarted. And hence, there is an incremental potential possibility of metals doing very well.